Welcome to the Old Capital Real Estate Investing Podcast with Michael Becker and Paul Peebles. During this program, you will hear interviews with real-life successful investors who will share their stories and provide useful advice on how to acquire, finance, and operate apartment complexes. Now, here they are, Michael Becker and Paul Peebles.
Welcome to the Old Capital Real Estate Investing Podcast. I'm your host, Paul Peebles, National Underwriter for Old Capital. And joining me today, as always, Michael Becker.
Hey, Paul.
And also Ricardo Hinojosa. Hey, Ricardo.
Hey, Paul. How are you?
Good. Hey, we're in for a treat today. We have two gentlemen that I want to introduce everyone to the podcast. Gentleman's name is Chase Maupin. Other gentleman is Kevin Chalmers. Now, Mike, were you ever in the military?
I was not.
Well, sometimes when you join the military, you go in with a buddy and you kind of go through basic training together and you kind of learn the basics of being a military enlisted person or an officer. In today's podcast, we're going to talk to these two guys that kind of went into the apartment real estate military, kind of learning from the basics. Now, two guys that own separate properties, but I thought we'd bring them together and kind of talk a little bit about their journey into apartments and how they got into it. So I'm excited to have the two guys. So Kevin, how are you?
Doing well. Thanks, guys. Thanks for having us.
Chase, how are you?
Doing good.
Good. So we're going to talk a little bit about their journey. So I'm going to kind of kick it off to Ricardo. And Ricardo, if you can kind of point us in the right direction.
Yeah, definitely. So let's start off with kind of a little bit, from a background standpoint. How do you guys know each other? Give us a feel for what you have done in the past and how you get started in multifamily.
We actually worked together. I was working in Houston and traveling to Dallas a lot to help Kevin out on his team. And finally, I just said, you need to get me to Dallas. And he made it happen, got me transferred up here, and I ended up living just down the street from him. So that formed a good friendship where we would carpool into work together. I joined his team permanently, and we started working very closely, trying to just do new and innovative things and find a better way to build a mousetrap until we realized that we didn't want to build mousetraps. We wanted to own apartments.
But you guys worked for the same company.
Yeah, exactly. Yeah. So, what you're talking about is before multifamily, way before multifamily. We sort of worked together in a very large company here in the Dallas area. Chase was based down in Houston where we used to work, and I used to manage a small team and needed somebody to put a better face on a product that we were cranking out, somebody to really automate what we were doing, and not to turn this into a software show, but brought Chase up, finally moved him up to Dallas, and worked on a lot of good projects, had a lot of great fun, really had a chance to see the world. And I think at some point you have certain projects squashed and a number of reorgs through corporate America, and things get old pretty fast, pretty quick, and the fun changes.
Did you guys know each other at Texas A&M?
No,
we didn't.
No, he's way older than I am. So we were in different classes.
Yeah.
So we missed each other during A&M.
So tell us a little bit about this journey. So you guys were in the high technology business. You guys made a decision to get into multifamily. How did that happen? How did that come about?
Small world, people who know people kind of thing. A good friend of mine at the office was involved in a local real estate education mentor group, and we were talking about savings plans, college savings plans at the time. And making a long story short, he turned me on to this group, and I got involved and went to a little workshop that they have locally, just kind of an intro class. And then later went to the big 2-day, I think is what it was, where they kind of open up, everything and show you what multifamily is all about. And, from a guy that had no real estate experience at the time, it was an eye opener. It was one of those things where it's almost too good to be true. And so I called up Chase. Actually, I think I texted you, right? It was more of a text because you weren't.
Well, we had gone to the workshop together because you said, "Have you heard of this group?" And I said, "Sometimes on the radio."
Yeah.
And we did the workshop and said, "Okay, we ought to look at it deeper." And then you sent me to India.
That's right. Yeah. So I texted him from here. He's in India. And said, "Hey, you got to check this out. This thing looks legit. I'm not going to tell you anymore. Do your 18 days or 3 weeks, whatever it was, come back and let me know what you think, when you do it next month." And so that's how we started.
Okay. Yeah. So buddies together with one company decided to get into real estate separately,
yeah.
But not really together. So you went through the educational piece.
So what about the multifamily business specifically kind of appealed to you most? I mean, what what caught your eye and really got you in?
I think for me and my wife personally, it was the returns, really. I think the opportunity when you look at multifamily from an income valuation perspective and what's possible with the cap rate versus the NOI, I think there was a no-brainer there in terms of what was possible in terms of gains and returns and our ability to really make that investment in multifamily versus single family. I mean, from that perspective, it was really not a question. It was more of you don't know what you don't know. And so there's all sorts of questions, when you jump in and we were just learning as fast as we could. But I think we always knew when we got into it that multifamily was where we wanted to be and start.
Yeah, so you took the first step, you got educated. So what happened next? How did you get into your first deal? Did you do some passive investments first, or did you jump right in and try to acquire a deal on your own?
Went passive investments first. That's how we jumped in. Our goal, especially for me, was just to be able to retire myself, right? To be able to focus on this, full time. So that's an indication of how much I thought about multifamily real estate. That's where we were mentally, is we needed to do passive investments to really get myself retired. And currently we're in 8 deals, 2,300 plus units as passive investors. And
holy cow.
Yeah. So, I mean,
what
that's
type of a time frame is that?
3.5 years. That's since August 2013.
That's when you flip the switch, huh?
That's when you flip the
Amazing.
switch pretty fast. Yeah. So and it's been a blast ever since, for sure.
So a number of passive deals. So walk us through how you made that decision to, hey, now I'm going to go lead my own deal. When did that happen? And just kind of talk us through that transformation.
Man, I don't know. I think you as well. I think we independently, separately always knew that we wanted to be lead investors. It
was a question of when,
Yeah.
right? It was always, I need to build up my passive investments to the point that I can walk away from everything. And then what am I going to do with my time? Well, I love real estate. Maybe I should be a lead investor. And then you start compressing your timeline and you start going, wait, I could do it now. I could start now owning my own properties and not just be passive. And it's going to accelerate that timeline where I can do real estate, which is what I love to do.
And Mike, what is a lead investor?
So when you're doing these deals, most of them are syndicated transactions, meaning that there'll be one person who's kind of the quarterback of the team. They'll go out and find the property, tie it up, put it together, then they'll go to their network and start raising money from passives, which is just kind of be investors in it, kind of like buying stock in a company. So Chase and Kevin are both started out doing passive and other people's deals and then came out and started doing their own.
Yeah.
Okay.
And I think, tying this back to corporate America, where we were always working in big projects, right? That was kind of what we did. We worked in big projects, had big deliverables. We sort of came from that mindset. And so that was just kind of in our DNA, I think, to be able to take on something as large as multifamily. You got to get your feet under you. You got to learn everything that you need to know with commercial real estate multifamily. But once you do that, I think these sorts of projects were something that kind of fit with us pretty well in terms of next step going forward.
So walk us through a little bit on your first deal. So each of you have purchased deals over the past, I think, 12 months. You started off with small deals and have now gone into some larger assets. But walk us through that first one, a little bit of detail about the specifics, where is it located, how you found it, the strategy on the deal, et cetera.
So our first one, we found it. It was out in Howe, which is a town that nobody's ever heard of. They think you're, playing an Indian, right? Howe. But it's just south of Sherman. We loved it because it was a market that was kind of untapped. People weren't really investing out there, but the occupancies were high. The rents hadn't been raised in years. So it was way under market. And it was a property that was small enough that we could really wrap our hands around it, get a lot of good experience managing it ourselves, and learn the business of management as well, so that when we moved on to our larger properties where we had professional management, we still knew what we were looking for. We understood what their jobs were and how, we should expect them to perform for us.
I'm going to go ahead and say you stole that deal because it was an amazing deal.
It was an amazing deal. I like that deal. And I'm selling it.
So back us up just a second. You guys are not partners on that deal.
No.
That's correct.
So
Right.
so again, we're talking about different silos.
Yes, two different silos. Yeah, and
So Chase has one silo, Kevin has one silo, but the funny thing is they both come from similar backgrounds,
Yeah.
similar company. They kind of got into the multifamily business together like buddies going through the war. They educated themselves, and now they're on buying properties.
And when we talk to each other all the time about our deals, about what we're looking at, what we're looking for, the underwriting of the deal. Hey, what do you think about this? How does this expense run for you? That kind of stuff. So while we're siloed in doing our own deals, we are together along with a lot of other like-minded investors, sharing our knowledge and sharing our experiences.
It's a partnership without the entity, if that makes sense. You
Yeah.
know what I mean? We communicate, talk to each other, resources get exchanged. I'll call him up, say, hey, I need to review some numbers. You got a few hours. We'll hang out, back porch, have a beer, and do that kind of thing. So it's, it works.
Who has the bigger portfolio between you two guys?
Of lead or passive?
Both. Let's say passive. Let's say passive.
Passive investments would be me with 8 properties, 2,300 units.
I've got 4 for a little over 1,700.
But he's got me in terms of lead investments. He's got 2 to my 1.
You'll
right
catch
now.
me though.
So, But that spurs us on, right?
Yeah.
So a little bit of
competition. I
a little
love it.
friendly
It's-
competition works. It keeps us
He'll
both
catch
on our
up for a
toes.
minute,
Yeah.
and then I'll get him again.
So back to your deal in Howe.
Uh-huh.
You purchased it about a year ago.
January 4th of this year.
Okay.
And we've got under contract to sell it January 6th of next year.
So talk to us a little bit about that. I mean, that's a quick turnaround. What was the strategy going in?
The strategy going in was to go in. We knew the rents were way under market. Again, they hadn't been raised in 4 years, and when the previous owner bought it, he only raised it $20. So it hadn't been raised effectively in like 8 years. So we knew we could go in, clean up this property. Needed a lot of rehab. Needed the exterior and interior just brought up to come out of the 70s. And we said if we can do that, then we can come in, buy it, raise that income, increase the value, sell it to somebody that's looking to hold it and just cash flow. And that's what our partnership wanted, was to just increase their equity, increase their capital.
And how much rehab into the deal?
We
Approximately?
put about 125 into it. I'm still sitting on about 14 of that. So then about 111 that we've actually spent.
And you're in contract to sell it.
Yes, sir.
Give us a feel for some numbers on returns. Did it meet your expectations? I mean, how are your investors feeling right now?
We exceeded our expectations, so they're pretty happy. We went in kind of saying if we're with our conservative numbers, if we sell this thing in a year, maybe we'll make about 70% gain. We're looking right now at about 128% gain, and I still have some of the year to make money on.
12 months, not bad.
And I've been dumping
Not
out
bad.
cash flow that they weren't expecting either. So,
That's pretty good.
yeah.
Very good. So Kevin, your turn. Talk us through your first deal.
Yep.
Kind of how you got into it, how you found it, where is it?
Small world with the multifamily market up here, and I'm sure elsewhere as well, is I met the broker who actually brought me my deal, which is up in Denton, small 16 unit. I met him at Chase's Due Diligence, where we were walking units, and had an introduction quick. I stayed in touch with him, and a few months later, I got the phone call that said, hey, I've got this deal for you. It's up in Denton, little 1970 16 unit, Class C. A lot of exterior work was already done, new roofs, new parking lot, new paint. I'm like, great, let's take a look at it. All 1 bedrooms. Denton is a killer market, as you guys know, a little suburb north of DFW Metroplex. 2 big universities there, which drives a lot of the economics. But that was really it. I mean, kind of jumped on that as quickly as I could.
Mike, talk a little bit about due diligence on some of these smaller properties. I mean, tell us a little bit about, now you buy much larger properties, but tell us a little bit about these smaller properties. What are some of the key metrics that you're looking for? on these
So,
properties?
the physical side is pretty similar. You just walk the units, make sure you have a good feel of what have been done on the inside, and then on the outside, just all the major components from the foundation on the bottom, the piping underneath it, to the roof and the siding, etc. So make sure you have a good understanding of what you're walking into from a physical standpoint. I'm sure they probably both experience this. Correct me if you're wrong, but when you buy these smaller deals, a lot of them are kind of more mom and pop. So what you don't see in the financials is almost more important than what is in there. So a lot of times they mow their own grass, there's no landscaping bill, or they trash out their own units, or they lease it themselves. So a lot of the times they don't account for what it would take if, say, another person would come in and buy it and hire and employ staff to do a lot of these functions. So was that something you guys noticed when you're going through either your due diligence, like lack of line items?
Maybe more of an overspend on mine. They had property management in place, but it was big time overspend. And I could see that in the numbers too, just based on it being a 16 unit. It's like, man, you got to be kidding. You're spending this much. So it was more on the other extreme. Instead of the underspend, it was the overspend on this property.
So they're using retail pricing on contractors and hiring, a big national plumbing company come in and fix a leak. What about you, Chase?
Mine, I will say that the books were relatively clean, but there was some of that just doesn't seem like the right price, or where's this line item? Okay, I need a budget that we're going to have to spend for this because, apparently there was some guy living there that was kind of doing stuff sometimes on the side.
For reduction of rent.
Yeah, living free, but never really delivering on time. So if you actually care about turning a unit in time and delivering it so you can get a tenant in there, you're going to have to pick up the expense of having a real professional come in and do the job.
And then, so Ricardo made you guys both each a loan. So I'm sure that's one of the things Ricardo could talk about when we're out there making loans on these properties that are on mom and pop. We almost have to come in and just normalize the expenses so the bank understands what they're doing. So I don't know, Ricardo, did you have to do any of that here to kind of help clean it up and tighten up the financial statements?
Yeah, definitely. So we had to do a little bit of that, not as extreme as what we've seen in other cases, because we did have somewhat of a set of financials. But with the small deals, there was a lot of the massaging and making sure that we've got the right numbers. And these guys did great at kind of showing, okay, how are we going to run it once we take it over? What does the pro forma and go forward numbers look like, which made things
Ricardo,
a lot easier.
You required to get a pro forma coming out of these guys' hands.
Absolutely.
Yeah.
So both these guys
2-year pro forma,
Yeah, 2 year, first year by month, kind of a 2 year outlook, by P&L line item, so we can get a good feel of what the expenses and income look like, going forward.
And how did you guys manage these smaller properties?
We're self-managing. My wife and I are self-managing the smaller property.
So you, Kevin, you're self-managing the property up in Denton?
Right.
And right now, Jace, how are you managing your property?
I self-managed as well. Actually, I did a move-in last night at 9 o'clock. My last move-in. But yeah, hey, that's when they could meet. Tenant got off at 8:15, had to run by the bank to make the deposit, and could meet me at 8:45, 9 o'clock. And I said, great, let's get you moved in and paying rent.
Wow. Now, Kevin, this is full-time for you now.
Full-time for me, yeah.
And Chase,
it will be in February.
It will be. So walk us through, some of the challenges. Kevin, when you started, you were working. How do you guys balance that? What are some of the challenges that you guys have faced from a just time commitment standpoint?
Well, for us, from Denton, we're an hour and 15 minutes away from Denton, so from this little 16 unit, self-managing it can be quite a chore to, if I had to drive out there every day to take care of a toilet or whatever, so it's not reasonable from that perspective. So us making sure that we had the right team locally to take care of that property in terms of handyman, plumber, that kind of thing, for stuff that would jump in, that was important for us to make sure that we had in place. Other than that, the rehab up front was big. We talked about the exterior on the 16 unit kind of being a done deal, which was great for our first deal. The interior was original 1970, so it needed a lot of TLC, especially to be competitive with the market comps in that area. A lot of big properties in the area, which we needed to be competitive with from a rent perspective. And so the kitchens were a full gut. And so we went in and scrapped everything in the kitchen and rebuilt it. That took a lot of time. Me being there, just working with the GC and the team, getting that level of finish and quality that we needed to push the rents where we did.
How do you market the property?
We use as many online tools as we can, apartments.com, Rent Manager, or Zillow Rent Manager, and all those normal tools that folks use, Rent Links and stuff.
Yeah, Hotpads, Trulia. Yeah. But Craigslist seems to win out, that and your big now leasing sign. It helps for us. We face the highway. Yeah. So I just put a big sign saying now leasing, because I'm always leasing even when I'm full, with our phone number. And I get a lot of calls from, I saw you sign.
Yeah, and we have our website too that we use. We don't have as much drive-by traffic. We're kind of on a side street, so we got like one corner of the highway maybe, but a lot of ours is just online marketing.
On these smaller properties, how do you guys collect rents?
Everything's automated. Everything's online.
Online only. Yeah.
So they have to have an account, and that account gets pushed over to your account?
Yeah, they can have a checking account, so they do an e-check, a debit card, a credit card, anything like that. And we've actually seen a lot from our tenants. One, they appreciate that. They don't like having to go get a money order. And two, we're seeing more and more of them that are getting paid on prepaid debit cards instead of getting a paycheck. So then they can turn around and use the prepaid debit card that their employer gives them for their paycheck and pay the rent with it.
And have you gotten the call at 2 o'clock in the morning that there was a toilet overflowing?
I've gotten the call at 7 o'clock in the morning that the main water line at the meter was busted and leaking down the side of the road. And that's always a treat to get because you don't know whose it is. 50-50 shot that it's the city. So I'm calling guys up, my handyman, say, hey, go take a look at it. Whose is it? And it's ours. So that was fun.
So you've owned the property now 6 to 9 months?
Yeah, 6 months
So how
now.
are things going? We talked about your pro forma. How are your rents doing versus what you expected?
We're above our year 2 pro forma at this point right now. So rents right now $765 on average. When we took it over, it was $635 on average, so $140 bump with the kitchens primarily. We upgraded the bathrooms as well and just basically paint and finish, and that was it. But we're hitting well above our year 2 performance right now, so doing really, really well.
And you guys did bank loans on those?
Yeah, we had a local bank, already knew the submarket, obviously, happened to know the asset, I believe, as well. So very happy with that. It was actually probably the easiest part of the whole transaction was, at least from my side, getting it financed through you guys.
Fantastic. I love hearing
Absolutely.
success
Well, and that's
stories.
the fun part is, it is important to get the right lending partner, right? You go into a bank and you say, hey, by the way, I'm setting up my business accounts, and they ask you what you're doing, and they would all say, oh, I'd love to lend to you on that. But they don't really know the business. They don't really know what you're trying to do. They just want to make you a loan. So you need that lending broker, that partner that actually knows the multifamily commercial real estate business and understands what your goals are to point you to the right product.
So now it's time to make the transition. So you guys started off as the small little ownership groups, and now you want to make it into the big leagues. Tell us a little bit about the transition that you're seeing right now. Are you happy, Chase, that you did a smaller deal before you did the larger deal?
Absolutely. Again, it lets me know where the books are, understand the financials, understand what I want to see out of operating the property, even though my second property is much larger and it has third-party management on it. I still feel a lot more comfortable, and I feel like I know what I can expect from them and what I find acceptable than if it were to say, if I didn't know anything and they just said, hey, well, this is how it is, how would I really know to push back?
What question to ask, yeah.
Exactly.
Yeah.
So tell us a little bit. I don't think we talked about what your second deal is. So tell us a little bit about your second deal. It was a 116-unit deal in Dallas. Is that right?
Yeah, 116 unit in Cockrell Hill. So it's North Oak Cliff area, just south of 30. A lot of good growth around there, high occupancy in the area. We really liked it because of that growth path and the high occupancy. It's an area that a lot of people just kind of overlook.
It's a transitional area.
Yeah.
So let's give me an idea how old the property is.
It was built in 65 and 68.
Okay, so 65 and 68, is it flat roof or pitched?
Both. There's 2 sets of buildings that are pitch roof and 1 set that's flat. It's very interesting. 2 sets are pitch roof with chillers. Another building is flat roof with these massive central ACs. So kind of different technology just between 65 and 68.
Wow.
It's like, some of these properties you walk on, you have like the HVAC history museum, got all the different ones throughout the years. So this property is a little bit more of a stabilized property versus well, I'm not saying the property and how is not stabilized, but a little bit more, the rents were a little bit closer to market versus what you walked into and how.
Yeah, the rents in this one were maybe about $100 under market. Now we think that we can actually go a little bit higher, but they were definitely about 100 under market. Whereas in how we went from 425 on a 1-bedroom to 640 on a 1-bedroom, and from 525 on a 2 to 750.
Got it.
So
That's really amazing, isn't it?
Yeah.
I mean,
And stayed 100% occupied.
and again, how much money did you have to put in on a per unit basis on the Howe property to generate that 200 plus door increase?
We put in about total with rehab about 35,000. Now, are you talking about just for the rehab per unit rehab? We do about, I'd say about 6,000, including my exterior in it. If I do just the interior, it's about 3,600 for an interior upgrade to bump that rent. And then my total rehab per unit would be about 6 because of all the exterior stuff that we had to do that still brings them in the door. Because if it doesn't look good on the outside, they don't really care what it looks like on the inside too much.
So this property being much larger, 5-6 times the size and being a little bit more stabilized, you guys were able to walk into a Freddie Mac loan, is that right?
Yes.
So tell me a little bit about that. So were you able to qualify as the sponsor of the deal by yourself, or did you generally when you get an agency loan, the agencies Fannie Mae and Freddie Mac want to have some level of experience in the ownership team. So were you guys able to qualify on your own, or were you needing to bring in
And they
somebody
ask for
else?
that ownership experience because they're doing a non-recourse loan. So they want to make sure that since the collateral is only the property, that you know what the hell you're doing
Yeah. So were they able to take your experience on the 20-unit property and or did you have to bring in somebody else with previous multifamily experience to join your team to get the loan?
I brought in more people from what I could tell, it was more of the net worth and liquidity side between myself and the fact that we bring in third-party management. I think they were happy with the management experience on that. And then I actually brought Kevin in as well as a KP because he was looking to get experience with the agency debt and didn't seem to hurt to bring him in as well.
And Kevin, why did you make that decision? And Ricardo, tell me why also.
Well, a few things for me. One, I trust Chase as a lead investor on this deal. The deal itself is a good deal with a great upside opportunity. So those are the two big reasons. The other one, just being a key principle in this deal, was because it allowed me to have the opportunity to benefit from a Freddie Mac or a Fannie Mae loan.
Yeah, definitely. So that gets him the experience that he needs because he's also out looking for larger deals.
Right.
So that's going to help him down the road when he's looking to sign on his next deal.
Yeah.
So going back to your KPs, so the experience you had in Howe, plus the fact that he was using an experienced third-party property management group that had experience in that submarket, fit Freddie Mac's needs from an experience standpoint. Mm-hmm. And then he had some additional KPs from a net worth, to meet those net worth and liquidity guidelines from Freddie Mac.
How many limited partners did you have, Chase, in that deal?
We totaled with ourselves 34 partners.
34 partners.
In that deal, yeah. Now, not all of them were KPs or anything. We had a primary KP ourselves on the note, and then Kevin wanted his experience, and then my parents actually joined as KPs because they also wanted experience with agency debt.
How much money did you have to raise to get the deal done?
We raised $2,080,000.
Okay, 34. Wow, yeah, it's quite the team to keep together there.
Yeah.
That's good.
Yeah, but we appreciate every one of them.
Any challenges raising the equity?
I will say that it was a little stressful at first. When I did my first property, I think I had all my money raised in 6 hours. I was done. And on this one, I went and I was probably hovering at about 53% of the money raised. And I went on vacation and I'm kind of, stressed out, going, where is everybody? I don't know what's going on. And then I had my meeting for my potential investors where I just walked them through it and talked to them like I'm talking to you now. And within a day or two after that, we were done. It was, despite all the information being given to them, a lot of people want to look you in the eye. They want to hear you tell them, why do you love the property? Why do you think it's a good deal?
I think that's a good learning point here that when you do a deal, you're out there either trying to borrow money or raise money. In my experience, everyone buys a story. So when you're trying to sell the deal to the lender, the having the $200 an upside in a unit or trying to raise money, it's that everyone buys a story. So having either a meeting or a webinar and you record it, those are really effective tools when you're out there raising money. And then, one of the things that we do is we do webinars, we record them, and then if you can't attend it, I have a recording an hour long, send it out. Then when it's convenient for you, you can listen to it your time, and then it takes out 95% of the questions.
I did the same thing. Yeah. We recorded that whole meeting, and people that couldn't attend in person attended online, and people that couldn't attend at that time could download and watch a video.
But that's the thing. But to Chase's point, so it's not only the deal they have to connect with, but they also have to trust that Chase or Kevin or whoever they're going to give their money to is trustworthy, honest, and has some good answers and a plan that they go out and implement to the process.
Jockey, not the horse.
Yeah.
That's right.
Did you guys do a PPM?
Yes, sir. Always.
And what does a PPM usually cost these days?
I was getting mine with the company agreement for $9,500.
Okay. Pretty good price.
Not bad.
Yeah.
And what are you guys using for software for management on the property?
They both actually use Resman, but the first one is my instance of Resman, and I use Aptex for all of our online payments. The second one, our management company uses Resman. That's another reason I like them. I'm familiar with the reports, with the software, with how it works. So I like that it's a cloud-based solution. I can access it from anywhere. It's very affordable and very capable.
Again, how many units is this property?
The second one is 116 units.
And how many employees do you have in the property?
We have a total of 3. We'll probably step one of the maintenance guys down to part-time in the 3rd year, but right now he's working to do more of our unit turns in the first 2 years. And then when we've turned our units and we're a little bit more just running stable and operating, then we can share him with another property.
Any absolute surprises that you found after you took ownership of the property?
Well, we had a chiller die, but it luckily was something that was easy to fix. But no, we haven't had any real shockers on that property. I will say the previous owner took good care of it. He'd done a lot of the heavy lifting on the exterior and the infrastructure. So it was really just interiors that are kind of dated.
So you're going through the interior upgrade now. What are you spending in total on the rehab?
In total on the rehab, we raised about $512,000 to do the rehab. Yeah.
And what's the long term? Is this kind of a longer term hold? Than
Yeah,
what you had
this is a 5 to 7 year hold. We'll investigate if a refinance, even with the prepayment penalty, makes sense starting in year 3 because our value's up. But we never pitched that as anything to expect. It was, hey, if things keep going ridiculously crazy here in DFW, it may make sense to pay a prepayment penalty and do this. But if not, let's expect to hold this thing 5 to 7 years before we get rid of it. But we'll cash flow nicely through it. And then we'll sell it and make a good capital gain.
Did you guys have to pay a hard earnest money to capture this deal?
We didn't. It didn't go hard on day one. $50,000 went hard at the end of our 15-day due diligence, and then the other $50,000 went hard at the end of our financing contingency.
And what type of terms on your loan was Ricardo able to get for you?
We got a 7-year term. We got 1 year of interest only, which was very nice. 30-year amortization, 4.39% interest rate, and 20% LTV.
20% down, 80% loan to value. And why a 7-year instead of a 10-year loan?
I wasn't really looking for a 10-year hold. 5 was a little short, 10 was a little long, but 7 was just right.
It's just like the Three Bears. I love it.
And we went with the step down prepayment penalty.
This one's yield maintenance.
Was it yield maintenance?
It was yield maintenance, yeah. And again, that was just an issue of, it wasn't really intended to be a refinance. If it happens and it makes sense, that's great. We'll see where interest rates were. But in particular, I'm kind of a bit of a conservative guy. I look at how hot the market is, and I knew I wanted to be in my preferred financing, going forward into the future rather than be coming out of a bridge loan. And that's why I liked the longer term, the 7-year.
And it's non-recourse too.
And non-recourse was definitely really nice, although we don't want to exercise that clause, right?
So, Kevin, how jealous are you of Chase?
Not jealous. I've got my plan. I'm participating in that one. So, you feed off each other. It's back
absolutely.
to the old competitive spirit. So we're looking hard for our next deal. And, I think we'll make it happen soon.
So I want to ask the expert at the table, Mr. Michael Becker, to give some words of wisdom to these young laddies.
No, I think that's what Chase was just saying about taking longer-term fixed-rate debt. I think that's pretty wise. That's the preferred method that I've done when we've done 10 or 12-year fixed-rate loans. And so I've been wrong every time. So I've been doing this for a few years now, and I've been wrong every time on all the 20 transactions I've done. And a lot of my competitors have been out there taking adjustable rate loans, and we're about a week. Well, we are a week after the election here, and if you go back and look at history here, when you listen to this podcast, you see what happened to the 10-year Treasury over the last 5 days. It spiked about 45 basis points. So there's a lot of nervous people out there. So if that continues, the people that have the long-term fixed rate debt will be, a lot more protected, and their downside mitigated a lot more than the people on adjustable rate loans. Right. So I concur with your strategy there, Chase. So what kind of wrapping up here? Some of the questions I have for you guys. So you're both passive in 8 deals, Kevin, and 4, Chase, before you started doing your own. What are some of the things that you've kind of learned by observing the leads that you're in the deals with that you were able to take into your own transaction? Whether there's 1 or 2 things that you can kind of think of that you observed some more experienced people that were a good lesson to learn that you maybe share with, an aspiring lead multifamily investor?
I would say probably the biggest one for me is to build your team, early and quickly as you can. I think, honestly, it comes down to that. I think anybody doing multifamily knows that it's a team sport. We always say that. Being successful in multifamily really requires having the right people in place, especially when you got the deal. When you hit LOI, things start moving really, really fast. When you get through the PSA, it's even faster. And so your feet to the floor as fast as you can. You have to have your team in place. And we were, I think, both fortunate to have already done that and have the right people in place to make that happen. That would be my advice.
Yeah, and I'd say averages, the rule of averages, because you're doing your due diligence and you'll walk into that unit and you just think there's no way somebody could live here. We should just burn this building down. I mean, it's terrible. And you just realize it averages out across all of your units. Some are more expensive, some are leased. So don't just get discouraged when you walk into that horrible unit. In fact, I tell people now when they walk into a unit and they go, "Oh, that stinks." I'm like, yeah, money smells like cat pee. That's what you want to smell, because you can fix that. And that's where you're going to make your money.
Good. So one of the things that Paul always likes to ask, is there any funny stories either you guys have had when you walk out on one of these properties? Anything kind of catch you as unusual besides the cat pee?
I'll say it again, none that I can say on a podcast, but it's all yours, Chase.
I guess, we hadn't owned our first property for too long, so we're still new owners, and I'm just trying to relax on the weekend, and my phone dings, and it's an email from a resident that says, "Cops all over the parking lot. I think it's a drug bust." And I'm freaking out. And so I race up there, and, I live about 40, 45 minutes away, and I probably did it in 35. And I get up there, and luckily it was just, they tried to pull somebody over on the highway, and he thought our parking lot looked like a great place to ditch and try to run. The good advantage of it was we got to meet all of the local police and formed great relationships with them. And in fact, when I had a work crew out there stumbling around looking for Unit Z, he pulled over to ask them what they were doing there, gave me a call. I said, that would be Unit 2, and they are supposed to be there. So, when you build those relationships, even through these kind of, incidents that you don't expect.
That's great. Well, I love hearing these stories. I love that you guys are coming together as friends and kind of working through your own silos and kind of going through this military business together. It's called real estate, and that you're having fun. And I tip my hat to you guys, and that doesn't happen too often, that two guys from, say, similar backgrounds, Texas A&M, high technology company, now we're in real estate together. Now our partners up in one or maybe in 2 or 3 more deals. I think that's great. So some great words of wisdom. We certainly appreciate that. Ricardo, thanks for hanging with us in the podcast. Michael, thanks for hanging with us in the podcast. And Chase Maupin, congratulations on closing deal number 2. And I can't wait for Kevin Chalmers to have deal number 2, 3, and 4.
Yep, coming your way.
Coming your way. Again, we appreciate you guys being in the podcast. If anybody wants to get some further information about just multifamily structure or lending, we'll kind of put together the map for you. Send us an email at info@oldcapitallending.com. info@oldcapitallending.com. We'll send you the 15-page white paper report on just kind of basic understanding about how to structure apartment loans. Just throughout the country, just kind of give you our basic insight of how we see it to help you. So again, we appreciate everybody listening to the podcast. I'm Paul Peebles. Have a good day.
Thanks for listening to the Old Capital Real Estate Investing Podcast. Please join us at oldcapitalpodcast.com to sign up for our weekly email updates. We'll see you next week for another great interview.